Preface. Macroeconomic forces affect all of us in our daily lives. Inflation rates influence the prices we pay for goods and services and, in turn, the value of our incomes and our savings. Interest rates determine the cost of borrowing and the yield on bank accounts and bonds, while exchange rates affect our command over foreign products as well as the value of our foreign assets. And all of this represents just the tip of the iceberg. Numerous macro variables, ranging from unemployment to productivity, are equally important in shaping the economic environment in which we live. For most business managers, a basic understanding of macroeconomics allows a more complete as well as a more nuanced conception of market conditions on both the demand side and the supply side. It also ensures that they are better equipped to anticipate and to respond to major macroeconomic events, such as a sudden depreciation of the real exchange rate or steep hike in the federal funds rate. Although managers can enjoy success even if they don't truly understand these sorts of macro variables, they have the potential to outperform their competitors, to see hidden opportunities and to avoid unnecessary and sometimes very costly mistakes after incorporating basic macro concepts and relationships into their management toolbox. In the 1990s, for example, managers who knew how to read and interpret a balance of payment statement had a definite leg up in dealing with the Mexican and Asian currency crisis. Similarly, those who understood the essential dynamic of a bank run and the power of negative expectations were better positioned to cope with the financial crisis of 2007 to 2009. Nor is the practical value of macroeconomics confined to business. A basic understanding of the subject is important to us as consumers, as workers, as investors, and even as voters. Whether our elected officials and the individuals they appoint to lead crucial agencies such as the Federal Reserve and the Treasury Department manage the macroeconomy well or poorly obviously has great significance for our quality of life, both now and in the future. Whether a large budget deficit is advantageous or disadvantageous at a particular moment in time is something that voters should be able to evaluate for themselves. Unfortunately, even many well-educated citizens have never studied macroeconomics, and those who have studied the subject too often learned more about how to solve artificial problem sets than about the true fundamentals of the macroeconomy. Macroeconomics is frequently taught with a heavy focus on equations and graphs, which for many students obscure the essential ideas and intuition that make the subject meaningful. Here, we attempt to provide a conceptual overview of macroeconomics, emphasizing essential principles and relationships rather than mathematical models and formulas. The purpose is to convey the fundamentals, the building blocks, and to do so in a way that is both accessible and relevant. Introduction. The most widely accepted measure of national output is gross domestic product, GDP. In order to understand what GDP is, it is first necessary to figure out how it is measured. The central challenge in measuring national output, GDP, is to avoid counting the same output more than once. It might seem obvious that total output should simply equal the value of all the goods and services produced in an economy, every pound of steel, every tractor, every bushel of grain, every loaf of bread, every meal sold at a restaurant, every piece of paper, every architectural blueprint, every building constructed, and so forth. But this isn't quite right, because counting every good and service actually ends up counting the same output again and again at multiple stages of production. A simple example illustrates this problem. Imagine that Company A, a forestry company, cuts trees in a forest it owns and sells the wood to Company B for $1,000. Company B, a furniture company, cuts and sands the wood and fashions it into tables and chairs, which it then sells to retailer, Company C, for $2,500. Company C ultimately sells the tables and chairs to consumers for $3,000. If in calculating total output, one added up the sales price of every transaction, 1,000 plus $2,500 plus $3,000, the result $6,500, would overstate the amount of output because it would count the value of the lumber 3 times in all 3 transactions and the value of the carpentry twice in the final 2. A good way to avoid the overcounting problem is to focus on the value added, that is, the new output created at each stage of production. If a tailor bought an unfinished shirt for $50, sewed on buttons costing $1, and then sold the finished shirt for $60, we would not say that he created $60 worth of output. Rather, he added $9 of value to the unfinished shirt and buttons, and thus created $9 worth of output. More precisely, value added or output created equals the sales price of a good or service minus the cost of all non-labor inputs used to produce it. We can easily apply this method to the ABC example just given. Because Company A sold the raw wood it had cut for $1,000 and had purchased no material inputs, it added $1,000 of value output to the economy. Company B added another $1,500 in value since it paid $1,000 for inputs from Company A and sold its output to Company C for $2,500. Finally, Company C added another $500 in value, having purchased $2,500 in inputs from Company B and sold $3,000 worth of final output to consumers. If one sums the value added at each stage, $1,000 plus $500, one finds that a total of $3,000 worth of output was created. Another and far simpler way to avoid the overcounting problem is to focus exclusively on final sales, which implicitly account for the output created in all prior stages of production. Since consumers paid Company C, the retailer, $3,000 for the final tables and chairs, we can conclude that $3,000 worth of total output was created. Note that this was precisely the same answer we came to using the value-added approach in the previous paragraph. Although both methods are correct, the second method, known as the Expenditure Method, has emerged as a standard approach for calculating GDP in most countries. The essential logic of the Expenditure Method is that if we add up all expenditures on final goods and services, then that sum must exactly equal the total value of national output produced, since every piece of output must eventually be purchased in one way or another. Government officials typically divide expenditure on final goods and services into 5 categories: consumption by households, C; investment in productive assets, I; government spending on goods and services, G; exports, EX; and imports, IM. One can find precise definitions for these categories. The most important thing to remember, however, is that all of these categories are designed to avoid double counting. Although consumption includes almost all spending by households, investment made in the business front are not all inclusive of firm spending. For a carpenter, a new electric saw would represent investment, whereas the lumber that he buys to turn into tables and chairs would not. Another possible source of overcounting in the expenditure method involves imports. If American consumers bought televisions from Asia, we would have to be careful not to count those consumer expenditures in American GDP, since the output being purchased was foreign, not domestic. For this reason, imports are subtracted from total expenditures and thus appropriately excluded from GDP. Putting these various pieces together yields one of the most important identities in macroeconomics. National output, GDP, equals C plus I plus G plus EX minus IM. This tells us that national output equals total expenditure on final goods and services, excluding imports. As we have seen, national output also equals the sum of value added, i.e. the incremental value added at every stage of production throughout the domestic economy. A third way to measure total output is to focus on income, though again in practice the expenditure method is used more often in calculating GDP. Income is the amount paid to factors of production, labor, and capital for their services, typically in the form of wages, salaries, interest, dividends, rent, and royalties. Since income is just payment for the production of output, it makes sense that total income should ultimately equal total output. After all of the proceeds of production ultimately have to end up somewhere, including in your pocket and mine. Chapter 1. Understanding Macroeconomy. Output. Sometimes one country may wish to exchange its output for that of another country. For example, the United States may wish to exchange commercial aircraft for Japanese automobiles. If the value of the US aircraft exactly equal the value of the Japanese automobiles at the moment of exchange, then both countries' trade accounts would be in balance. That is, exports would exactly equal imports in both the United States and Japan. One puzzle is why any country would want to run a trade surplus, which involves giving more of its output away to foreigners in the form of exports than it receives in return in the form of imports. Why would any country wish to give away more than it received? The answer, in a nutshell, is that countries running trade surpluses today expect to get back additional output from their trading partners in the future. This transfer across time is ensured through international lending and borrowing. When a country exports more than it imports, it inevitably lends an equivalent amount of funds abroad, which allows the foreigners to purchase its surplus production. Conversely, when a country imports more than it exports, it must borrow from foreigners to finance the difference. By borrowing, it is promising to pay back the difference, typically with interest, at some point in the future. If, for instance, the United States were to import automobiles from Japan without exporting anything in return, it could pay for these automobiles only by borrowing from Japan. This borrowing could take many different forms. Americans could borrow directly from Japanese banks, or they could give the Japanese stocks or bonds or other securities. Whatever form the borrowing took, the Japanese would end up with assets, such as stocks or bonds, promising a claim on future US output. Eventually, when the Japanese decided to sell their American stocks and bonds and use the proceeds to buy American airplanes, movies and software, the trade balances of the two countries would flip. Now, the United States would be required to run a trade surplus, shipping some of its output to Japan and thus forcing Americans to consume less than they produced. The Japanese, meanwhile, would now run a trade deficit, permitting their consumption to exceed their production, with the difference coming from the United States. All international transactions of this sort are recorded in a country's balance of payments, BOP statement. Current transactions such as exports and imports of goods and services are recorded in the current account. Financial transactions, including sales of stocks and bonds to foreigners, are recorded in the financial account, which was formerly called the capital account. Deficits on the current account are necessarily accompanied by capital inflows, borrowing on the financial account, whereas surpluses on the current account are accompanied by capital outflows, lending on the financial account. As a result, the current account and the financial account are perfect opposites, with the deficit in one necessarily accompanied by a surplus of the same amount in the other. Current account deficits should not necessarily be interpreted in a negative light, since they can indicate either weakness or strength, depending on the context. In some cases, current account deficits imply that a country is living beyond its means, increasing its consumption to an unsustainable level. But current account deficits can also arise when a country is borrowing from abroad in order to raise its level of domestic investment, and thus increase its future output. The question for deficit countries, therefore, is whether they are using the additional output well, whereas for surplus countries it is whether they can expect a good return in the future on the output they are giving to others today. Although balance of payments accounting may be unfamiliar to you, it is not really as difficult as it may seem. In fact, the fundamental issues should become a good deal clearer through a simple analogy to your own personal budget. The amount of output that you produce, that is, your individual output, is reflected in your personal income. If you are employed, you are paid wages or a salary for your contribution to output. If you own capital, such as bank accounts, bonds or stocks, you are paid interest or dividends for its contribution to output. If you wish to spend more than you produce, i.e. to buy more than your total income permits, then you have to borrow or at least draw down your savings to finance the difference. This excess spending may be used to finance increased consumption, such as a 2-week holiday in Europe, or a new personal investment, such as additional education or an entrepreneurial venture that promises to increase your earning power in the future. Either way, for you to borrow, someone else has to lend, which in turn means that that person is producing more than he or she is spending and saving the difference so it can be lent to you. Someday you will have to repay the loan, presumably with interest. When you do that, you will have to consume less than you produce, i.e. consume less than your income would otherwise permit, because you will have to turn over part of your income to your creditor in the form of interest and principal repayments. For a country, it is basically the same thing. If a nation is running a deficit on its current account by importing more than it exports, for example, then it is using more output than it is producing, and it is borrowing the difference from foreigners, which registers as a surplus, a capital inflow, on the financial account of its BOP statement. The key point is that for a country, as for a person, the long-term constraint on consumption and investment is the amount of output that can be produced. A country, like a person, can use more output than it produces in the short run, by financing the difference through borrowing, but not over the long run. A nation's output, its GDP, thus represents its ultimate budget constraint, which is why the notion of national output lies at the heart of macroeconomics. On the relationship between output and trade, see a brief aside on the theory of comparative advantage. Chapter 2. Productivity. Some basic principles can be applied to entire economies, even though one single factory situation can be used to illustrate it. A national economy may increase its GDP by increasing the total number of person-hours worked, labour, by increasing the total amount of plant and equipment in use, capital, or by increasing the efficiency with which labour and capital are used, TFP. So-called supply-side economists focus their attention on how to grow all three of these factors in order to increase the total potential output, the supply side of an economy. One favourite method among supply-siders in the United States is the reduction of tax rates. For all of these reasons, supply-siders in the United States have often favoured reductions in tax rates as the best way to grow GDP over the long run. Other economists, including many outside of the United States, have at times argued almost exactly the opposite, that government-led investment in public infrastructure, education and R&D, for example, can be the best way to build the capital stock, enhance the labour force and promote innovation, and thus the best way to boost long-run economic growth. Although they, too, focus on the supply side, they have a very different conception of the optimal use of public policy in boosting potential output, supply. Causes of economic downturns, recessions and depressions. Another question of great importance among macroeconomists is what makes output decline or grow more slowly. Clearly, anything that causes labour, capital or TFP to fall could potentially cause a decline in output or at least a decline in its rate of growth. A massive earthquake, for example, could reduce output by destroying vast amounts of physical capital. Similarly, a deadly epidemic could reduce output by decimating the labour force. Even something as seemingly non-economic as religious strife could reduce output by increasing tensions among employees of different faiths and thus reducing their collective efficiency and, in turn, TFP. In some cases, however, output may decline sharply even in the absence of any earthquakes or epidemics. From 1929 to 1933, for example, national output declined by more than 30% in the United States. Economists and policymakers alike were as puzzled as they were horrified. President Herbert Hoover observed in October 1930 that although the economy was in a depression, the fundamental assets of the nation have been unimpaired. the gigantic equipment and unparalleled organization for production and distribution are in many parts even stronger than 2 years ago. Similarly, in this inaugural address in early 1933, President Franklin Roosevelt maintained that our distress comes from no failure of substance. We are stricken by no plague of locusts. Plenty is at our doorstep, but a generous use of it languishes in the very sight of the supply. Since all the necessary inputs, labour and capital, were there, why had output fallen so dramatically in just a few short years? The British economist John Maynard Keynes claimed to have the answer. If our poverty were due to earthquake or famine or war, if we lacked material things and the resources to produce them, he wrote in 1933, we could not expect to find the means to prosperity except in hard work, abstinence, and invention. In fact, our predicament is notoriously of another kind. It comes from some failure in the immaterial devices of the mind. Nothing is required, and nothing will avail except a little clear thinking. His key insight, implied by the phrase immaterial devices of the mind, was that the problem was mainly one of expectations and psychology. For some reason, people had gotten it into their heads that the economy was in trouble and that belief rapidly became self-fulfilling. Families decided that they had better save more to prepare for the future. Seeing a drop in consumption on the horizon, businesses decided to scale back both investment and production, leading to layoffs, which reduced workers' incomes and thus exacerbated the drop in consumption. Driven by nothing more than expectations, which Keynes would later refer to as animal spirits, the economy had fallen into a vicious downward spiral. Although the economy's potential output remained large, since all the same factories were still there and the same workers still available, if called upon, actual output had collapsed as a result of a severe shortfall in demand. In principle, such a collapse could not have occurred had prices been perfectly flexible and adjusted instantly to re-equilibrate supply and demand. For example, if wages had fallen fast enough and far enough to reflect a reduced demand for labour, all unemployed workers would quickly have found new jobs, though admittedly at lower wages than they had enjoyed before. The point is that even with sudden changes in expectations, resources would never go to waste or remain unemployed if the price mechanism worked perfectly. In practice, however, markets sometimes falter. For reasons that are still not fully understood, prices can be rigid or sticky, meaning that they don't always adjust as quickly or as completely as they should. As a result, a negative shock, including a sudden downturn in expectations, truly can drive an economy into an extended recession where real incomes decline and both human and physical resources are left unemployed. Starting around the time of Keynes, therefore, economists began to realize that there was more to economic growth than just the supply side. Demand mattered a great deal as well, particularly since it could sometimes fall short. In fact, over roughly the next 40 years, it became an article of faith among leading economists and government officials that it was the government's responsibility to manage demand through fiscal and monetary policy so as to reduce the duration and the severity of economic recessions and thus help stabilize the business cycle. Chapter 3. Money. Although output is more important than wealth in the study of macroeconomics, one particular form of wealth, money, occupies a very special place in the field. Without money, the exchange of goods and services would be far less efficient. Just imagine how complicated trade could become in the absence of money. If you were a farmer who grew wheat and wanted to take your family out to dinner, you would have to find a restaurant willing to accept a few bushels in exchange for a meal. Otherwise, you would have to figure out what the restaurant owner wanted, say, new chairs, and then find a furniture maker who was willing to trade chairs for wheat. And think what would happen if the furniture maker wasn't interested in wheat, but wanted a new hammer instead. Clearly, having one convenient commodity that everyone was willing or required to accept as payment would simplify the process immensely. And this is precisely why money is used as a medium of exchange in every market economy around the world. In a monetized economy, where people transact with money, anyone wishing to purchase your wheat, would simply pay money for it, allowing you to buy a meal at a restaurant or anything else you might want, subject solely to your having enough money to cover the cost. At least since the dawn of the nation-state, national governments have taken charge of defining what money is in their economies. Eventually, almost every national government also took charge of creating its own currency, either by coining it or printing it itself. As we will see, how a government does this has enormous implications for how its economy functions and what types of risks its residents face in the marketplace. Money and its effect on interest rates, exchange rates and inflation. Although money plays a vital role facilitating exchange, it also affects several variables that are of great interest to macroeconomists: interest rates, exchange rates, and the aggregate price level. In an important sense, all three of these variables constitute prices of money. The interest rate can be thought of as the price of holding money, or alternatively as the cost of investment funds. In general, most people would prefer to receive $100 in cash now than to receive the same $100 in cash a year from now. Economists characterize this trade-off as the time value of money. A consumer may take out a loan and agree to pay interest on it in the future, in order to receive cash to spend immediately. Perhaps this consumer prefers to start enjoying a new television set right away rather than saving up for a year before enjoying it. Similarly, business managers may wish to borrow from a bank or float bonds when the interest rate on borrowing is lower than the return they expect they can make on a new investment. When interest rates rise, money obviously becomes more expensive both for individuals and for firms, and thus the cost of buying things today relative to tomorrow or next year goes up. In part for these reasons, rising interest rates tend to slow the growth of output in the economy by slowing current consumption and investment, whereas falling interest rates tend to accelerate the growth of output by stimulating current consumption and investment. If it costs 100 yen to buy $1, then the yen to dollar exchange rate is 100. Conversely, the dollar to yen exchange rate is 0.01. If the yen to dollar exchange rate subsequently fell to 90, this would mean that the dollar had depreciated and the yen had appreciated, since it now took more dollars to buy 1 yen and fewer yen to buy $1. When a country's exchange rate depreciates, foreigners will find it cheaper to buy that country's currency, which may lead them to buy more of the country's goods as well. It is for this reason that a depreciating exchange rate is often regarded as being favourable for a country's exports. There is no free lunch, however. A depreciating exchange rate also means that foreign currencies, and thus foreign goods, appear more expensive to the country's citizens, thus reducing their overall purchasing power. The aggregate price level, sometimes called the price deflator, is a bit more complicated since it is not the price of any one thing in particular. Broadly speaking, the aggregate price level reflects the average price of all goods and services, or at least of a broad subset of goods and services, in terms of money. In a healthy economy, the money prices of individual goods and services are changing all the time. At any moment, some may be rising and others falling. For example, the price of milk might be rising while the price of computers is falling. There are times, however, when one can detect trends across all, or at least most, prices. In a period of inflation, when the aggregate price level is increasing, most prices tend to rise, though some will inevitably rise more than others. In a period of deflation, by contrast, when the aggregate price level is decreasing, most prices tend to fall, though again some will fall more than others. It should not be hard to see that the value of price of money in terms of goods and services moves in exactly the opposite direction as the aggregate price level. When the price level rises in a period of inflation, the value of money falls, and when the price level falls in a period of deflation, the value of money rises. 3 prices of money. Chapter 4. Money and Banking. We have talked quite a bit about money without saying much about where it comes from or about the different forms it takes. In most countries, only the government can issue currency, which is legal tender and therefore required by law to be accepted as payment for all debts. Take a look at a dollar bill and note what is imprinted on the front. This note is legal tender for all debts, public and private. Currency thus serves as a very reliable and convenient means of payment for many transactions. Typically, national central banks take responsibility for deciding how much currency to issue. If you take another look at the dollar bill, you will notice the words Federal Reserve Note printed at the very top, indicating that the bill is an obligation of the Federal Reserve. Although the central bank decides how much currency to issue, it is important to recognize that the central bank is not the only institution that creates money. Commercial banks play a crucial role as well. This is because currency is not the only form of money. According to a standard definition of the money supply known as M1, checking accounts also count as money, since checks are widely accepted as a means of payment and are highly liquid, that is, they can easily be converted to currency. Because checking accounts allow the account holders either to withdraw or to transfer the deposited funds on demand, economists typically refer to these accounts as demand deposits. And demand deposits are an important component of the money supply. At the end of 2012, there was a total of $1,091 trillion worth of U.S. currency, i.e. $1 bills, $5 bills, $10 bills, and so forth, in circulation. At the same time, banks and thrifts held a total of $1,345 trillion in demand and other checkable deposits. As just noted, M1 money supply includes these two items: currency in circulation and demand deposits, both of which are widely used and widely accepted as means of payment. Because checking accounts constitute an important form of money, commercial banks play a vital role in money creation. Through a process of taking deposits and lending out most of the funds received, banks actually expand the money supply beyond the amount of currency in circulation. Imagine, for example, that you go to the bank and deposit $100 in cash into your checking account. At that moment, the size of the overall money supply doesn't change. You have an additional $100 in your checking account, but the $100 you once had in your pocket is now in a bank vault. Because the cash is no longer in circulation, it is not included in M1 money supply. However, in most cases, the bank will quickly lend out most of that cash, limited only by a legal reserve requirement, which compels the bank to keep about 10% of the cash on reserve. Now the money supply has increased. You have your $100 in the form of a demand deposit checking account, and the person who borrowed from the bank has, say, $90 of the cash that you used to have in your pocket. So the money supply has increased by $90. As you may have guessed, however, the process doesn't end there. If the borrower buys something with that cash and the recipient deposits it in his bank, then the process will start all over again and even more money will be created. To see how much money will be created based on an additional dollar of deposits, economists calculate the so-called money multiplier. The money multiplier simply equals 1 of the proportion not lent out, also known as the leakage from the deposit and lending process. Thus, money multiplier equals 1 to proportion of leakage. If banks always lent out 90% of deposited funds and all lent funds were ultimately redeposited, then the leakage would be 10% or 0.10, and the money multiplier would be 10, i.e. 1 to 0.10. This implies that a single dollar of currency would turn into $10 of total M1 as a result of the deposit and lending process. In practice, the money multiplier is much smaller than 10, in part because individuals don't deposit nearly all of their cash in checking accounts, meaning that total leakage is considerably higher than 10%. Even so, banks still play a very large role in money creation. One obvious problem with this mechanism is that if everyone who had deposited funds in a bank asked to withdraw their cash at the same time, the bank would not be able to comply, since it had lent out a large proportion of their funds. Normally, this is not a problem, since total withdrawals tend to be relatively small and thus manageable on any given day. But the simple fact is that if a large proportion of depositors demand their cash at the same time, either because they all need it for some reason or out of fear that their bank is in trouble, then the bank will fail. This is known as a bank run or bank panic. A very similar dynamic was visible during the financial crisis of 2007 to 2009, although this time mainly among so-called shadow banks, which operated without federal insurance. Conclusion. Although commercial banks certainly help create money, central banks are particularly important to macroeconomists because they have the power to expand and contract the money supply. Central banks can literally create money at will, and they can also destroy it. Prior to the financial crisis of 2007 to 2009, central bankers typically regarded short-term interest rates, not the money supply itself, as the primary instrument of monetary policy, and they manipulated the money supply as needed to produce the interest rates they desired. If the directors of a national central bank decided, for example, that they wanted to lower the overnight bank rate from 3.0% to 2.5%, they would announce the change in policy and would increase money growth as much as was necessary to drive the overnight rate down to 2.5%. In fact, if the central bank was highly credible, the announcement itself might be enough to drive the rate down to 2.5%. Even so, the central bank would still probably accelerate money growth to support the new rate. Despite the importance of the short-term interest rate, money is actually the factor that central banks control most directly. In fact, they exercise complete monopolistic control over the monetary base, including the nation's supply of currency, and they are able to move interest rates only because of that control. If the government ever gave up its monopoly over legal tender currency, the central bank's ability to set short-term interest rates would disappear as well. It is a bit like the relationship between the speedometer and the gas pedal on a car. When drivers wish to go faster, they press on the gas pedal and watch the speedometer. Although increased gas flow to the engine is what makes the car go faster, drivers generally set their targets in terms of speed, miles per hour, rather than gallons per hour of gas flow. In monetary policy, although money is ultimately the gas that makes the car go, central bankers generally focus on the short-term interest rate as their main policy instrument, rather than the money supply itself. However, after the US Federal Reserve had pushed the short-term interest rate essentially to zero to combat the financial crisis of 2007 to 2009 and the resulting economic downturn, American central bankers began to rely more heavily on monetary expansion itself. The term quantitative easing, which in the US context implied the purchase of longer-term instruments ranging from mortgage-backed securities to corporate debt, ideally to help lower longer-term interest rates, became part of the economic lexicon. For a fuller definition, see the glossary. In principle, central bankers can use monetary policy in the pursuit of many different objectives. If they believe GDP is growing too slowly or that unemployment is too high, they can reduce interest rates in order to stimulate economic activity. Conversely, they can raise interest rates if they think inflation is too high or is about to become too high as a result of rapid and unsustainable GDP growth, overheating. They can also target a particular exchange rate, raising interest rates when their currency falls in value relative to other currencies, and lowering interest rates when it rises relative to other currencies. Or they can reduce interest rates and expand the money supply in times of financial turmoil to help stabilize the financial system. In practice, most central bankers are mindful of all these objectives: vigorous but sustainable GDP growth, low inflation, steady exchange rates, a stable financial system, and so forth. Note, however, that there are often trade-offs involved. If a central bank raises interest rates to reduce inflation, for example, it may slow GDP growth and raise unemployment at the same time, a trade-off suggested by the so-called Phillips curve. An increase in the interest rate may even cause the nation's currency to appreciate, which could further weaken the domestic economy by undercutting exports. Clearly, it is not possible to achieve all of the various objectives simultaneously. In recent times, most central bankers appear to have made low inflation their dominant policy objective. Yet in the heat of the 2007 to 2009 crisis, financial stability seemed to become the top priority, at least for the Federal Reserve.